All right, buckle up because today we're diving headfirst into the world of cryptocurrency. But not just any crypto deep dive. This time we're talking about how you can actually make money with it.
It's fascinating because there's so many different ways to potentially profit from crypto. It's not just a one-size-fits-all kind of thing.
Exactly. We've got this awesome guide in front of us that outlines 9 different strategies, from simple buy and hold tactics to more complex things like yield farming, which honestly sounded like magic internet money to me at first.
We'll definitely demystify some of those terms for you today. The goal is to help you figure out which of these strategies might be worth exploring based on your own goals and comfort level with risk.
So let's start with something I think a lot of people are familiar with, at least in concept. Buying and holding, or as the cool crypto kids call it, HODling.
This one is pretty straightforward. You buy a cryptocurrency that you believe has long-term growth potential, and then you hold on to it, weathering any storms that might come your way.
Think of it like planting a tree. You wouldn't dig it up every few days to see if it's grown, right? You give it time to take root and flourish.
Exactly. The guide mentions Bitcoin, Ethereum, Solana, and Cardano as popular choices for this approach. They've all seen significant growth, though of course, past performance doesn't guarantee future returns.
Which is why doing your research is so important. You need to understand the technology behind the cryptocurrency, the team behind the project, and the overall market trends.
The key insight here is to focus on the why behind your investment. If you truly believe in the long-term potential of a particular cryptocurrency, you'll be less likely to panic sell when the market gets bumpy.
And let's be honest, the crypto market can be like a roller coaster sometimes. But if you've done your homework and you're in it for the long haul, those dips can actually be opportunities to buy more at a lower price.
Now, let's talk about a strategy that can potentially generate passive income while you HODL. Staking.
When I first heard about staking, it kind of blew my mind. It's like your crypto is out there, working for you, even while you sleep.
It is a fascinating concept. Essentially, you're locking up your cryptocurrency to help support the operations of a blockchain network. And in return for this contribution, you receive rewards, typically in the form of more of that cryptocurrency.
It's like earning interest on your savings account, but instead of a bank, you're participating in a decentralized network.
Now, choosing the right staking platform involves balancing potential rewards with the length of time your crypto is locked up. Some offer higher returns, but require longer lockup periods, so you need to consider your investment timeline.
The guide highlights Ethereum 2.0, Polkadot, and Tezos as popular choices for staking. But as always, research is key. You need to make sure you understand the specific staking mechanisms and risks involved.
Security is another crucial factor to consider. You want to choose a reputable staking platform that has a proven track record of security and reliability.
Okay, ready to step things up a notch? Let's talk about trading.
Trading. It's the heart-pumping, adrenaline-fueled world of trying to predict the unpredictable, short-term price movements.
It sounds a little intense for me, to be honest, but I know some people thrive on that kind of excitement.
Absolutely. And there are different approaches to trading, each with its own levels of risk and reward. Day trading, for example, involves making multiple trades within a single day, trying to capitalize on small price fluctuations.
Wow, that sounds exhausting. Do you need to be glued to your computer screen all day to do that successfully?
It definitely requires a lot of time, focus, and emotional discipline. You need to be able to analyze charts, identify patterns, and make quick decisions based on market movements.
Then there's swing trading, which sounds a bit more my speed.
Swing trading involves holding positions for days or even weeks, trying to ride the waves of market swings rather than reacting to every little blip. It's less intense than day trading, but still requires a good understanding of market analysis.
And then there's scalping, which sounds like something only professional race car drivers should attempt.
Scalping is the most extreme form of trading. It involves trying to make tiny profits from incredibly short-term price movements, often executing multiple trades within minutes or even seconds.
Yeah, I think I'll leave that to the experts.
It's definitely not for the faint of heart. The key takeaway here is that trading can be lucrative if done right, but it's crucial to understand the risks involved and approach it with caution.
So we've got buying and holding for the patient investors, staking for those who want their crypto working for them, and trading for the adrenaline junkies. What's next?
Let's dive into the world of DeFi, or decentralized finance, starting with a strategy called yield farming.
Okay, so you mentioned yield farming earlier. Remember when I said it sounded like magic internet money? Can you break that down for our listener in a way that even I can understand?
Of course. Imagine you're lending your cryptocurrency to a platform, kind of like putting your money in a savings account. But instead of a bank, you're lending to a decentralized protocol. And instead of earning a tiny bit of interest, you're earning a potentially much higher returns in the form of other tokens.
So it's like a high-yield savings account, but with crypto.
That's a good way to think about it. You're essentially providing liquidity to these DeFi protocols, and in return, you're rewarded with a share of the fees generated by the platform.
The guide mentions Uniswap, PancakeSwap, and Aave as examples of platforms offering yield farming opportunities. Are those all basically the same?
They all operate on similar principles, but each platform has its own unique features, risks, and rewards. And there are a lot of other platforms out there too.
So what are some of the risks involved with yield farming? Because it sounds almost too good to be true.
Well, there's a concept called impermanent loss, which is essentially the risk that the value of your deposited assets will change relative to the assets you're earning as rewards. It can get a bit complicated, but the bottom line is that you could potentially lose money if the market moves against you.
Okay, so definitely do your research before jumping into any yield farming pools. What about security? Is that a concern with DeFi?
Security is paramount in the crypto world, especially when you're interacting with decentralized platforms. You need to make sure you're using reputable protocols, auditing smart contracts, and taking all the necessary precautions to protect your assets.
All right, so yield farming sounds like it has the potential for high rewards, but also comes with some risks that need to be carefully considered. Got it.
Now let's shift gears and talk about something that's been around since the early days of cryptocurrency. Mining. It's the backbone of many cryptocurrencies, but it's also become quite resource intensive in recent years.
Mining is essentially the process of validating transactions and adding them to the blockchain, right? But how does that actually work?
Imagine a giant decentralized accounting ledger that keeps track of every single cryptocurrency transaction. That's the blockchain. And miners are the ones who verify those transactions and add them to the ledger.
So they're like the bookkeepers of the crypto world.
Exactly. And they do this by solving complex mathematical problems. The first miner to solve the problem gets to add the next block of transactions to the blockchain and is rewarded with newly minted cryptocurrency.
So you need a powerful computer to be a miner.
In the early days of Bitcoin, you could mine with your home computer. But as the network grew and more miners joined the competition, the difficulty of those mathematical problems increased exponentially.
So what do you need to mine cryptocurrency these days?
You need specialized hardware called ASICs or GPUs, which are designed specifically for mining. And you need access to cheap electricity because mining consumes a lot of energy. It's become an industrial scale operation.
I've also heard of something called cloud mining. What's that all about?
Cloud mining is essentially renting mining power from a company that has large mining farms. It's a way to participate in mining without having to purchase and maintain your own equipment.
So it's like outsourcing your mining operation.
Exactly. But as with anything in the crypto world, you need to do your research and choose a reputable cloud mining provider.
Okay, so mining can be profitable, but it requires significant upfront investment and ongoing costs. Definitely something to consider carefully.
Now, let's talk about something a bit more fun and engaging. Play-to-earn games, or P2E for short. This is where the worlds of gaming and crypto collide, creating a whole new way to earn digital assets.
I actually tried out Axie Infinity myself a while back, which is one of the more popular P2E games. It was fascinating to see how the game mechanics were tied to earning tokens, and it definitely got me thinking about the future of gaming.
It is a fascinating development. These P2E games allow players to earn cryptocurrency or NFTs by completing tasks, winning battles, or trading virtual assets within the game's ecosystem.
So instead of just racking up points or high scores, you're actually earning something of value that can be traded or sold.
Exactly. It's a whole new way to think about gaming, and it's attracting a lot of attention from both gamers and investors.
The guide also highlights Decentraland and the Sandbox as popular P2E platforms. What are those like?
Decentraland is a virtual world where players can own land, build structures, and create experiences that can be monetized. Imagine buying virtual real estate and then renting it out or selling it for a profit.
That's wild. And the Sandbox?
The Sandbox is another virtual world that focuses on user-generated content and NFTs. Players can create and trade NFTs, participate in games and events, and earn rewards for their contributions.
So it's like a metaverse where you can earn real money.
Exactly. These P2E games are blurring the lines between gaming, entertainment, and earning, and they're definitely worth checking out.
Okay, so we've covered buying and holding, staking, trading, yield farming, mining, and P2E games. Are we missing anything?
Let's talk about a classic way to earn money that has found a natural home in the crypto world: affiliate programs.
Affiliate programs are all about leveraging your network to promote products or services and earn commissions, right?
Exactly. Many crypto exchanges, wallets, and other platforms offer affiliate programs. You refer new users to the platform, and if they sign up or make a purchase, you earn a commission.
So if you have a website, blog, social media following, or any other online presence, you can potentially earn passive income by promoting crypto products or services.
Precisely. The key to success with affiliate marketing is to choose products or services that you genuinely believe in and that align with your audience's interests.
And to promote those products ethically and transparently. You don't want to be that spammy friend who's always pushing questionable products.
Absolutely. Building trust and credibility is essential for long-term success with affiliate marketing.
Speaking of sharing your knowledge, there's another opportunity that I think a lot of people overlook: creating content or educational materials related to cryptocurrency.
That's a fantastic way to earn money while also contributing to the growth of the crypto community.
The demand for crypto education is constantly growing. There are so many people who are curious about crypto but don't know where to start.
You could create YouTube tutorials, write blog posts or articles, host webinars, or even develop online courses.
Yeah.
The possibilities are endless.
And you can monetize your content through ads, sponsorships, paid subscriptions, or by selling your own educational products.
The key is to provide valuable, accurate, and engaging content that caters to your target audience's needs.
Okay, one last strategy to cover before we wrap up this part of our deep dive. What are ICOs and token sales all about?
ICOs, or initial coin offerings, and token sales are essentially crowdfunding mechanisms for new crypto projects. You're investing in a project at its early stages, hoping that the token's value will increase once it hits the market.
So it's like investing in a startup, but instead of buying shares, you're buying tokens.
Yeah, it's a good analogy. But it's important to remember that ICOs and token sales are very high-risk investments. There's a lot of potential for scams and rug pulls where the developers disappear with the investors' money.
Remember the Mt. Gox hack back in 2014? It's a stark reminder that security is paramount in the crypto world. You need to be proactive in protecting your assets.
Absolutely. And doing your own research is crucial. You need to carefully scrutinize the project's team, technology, white paper, and overall potential before investing any money.
Wow, that's a lot to take in. We've covered so much ground already, from buying and holding to yield farming, mining, P2E games, affiliate programs, content creation, and even ICOs.
And we've only just scratched the surface. But hopefully this has given you a good overview of the different ways you can potentially earn money with cryptocurrency.
We'll be back soon with part 2, where we'll dive deeper into specific strategies and share some practical tips for getting started. Welcome back to our crypto adventure. I'm still trying to wrap my head around all the different ways you can make money with this stuff.
It is a vast and ever-evolving landscape, that's for sure. But that's also what makes it so exciting.
Totally. Okay, so in the last part, we gave a quick overview of 9 different strategies. Now it's time to roll up our sleeves and get a little more hands-on with some of them.
Sounds good to me. Where should we start?
Let's pick up where we left off with staking. I'm really intrigued by the idea of earning passive income with my crypto.
Staking is definitely a popular choice for those who want to put their crypto to work without actively trading.
In the last part, we talked about how staking involves locking up your crypto to support a blockchain network and earning rewards in return, but how do you actually choose a staking platform?
That's a great question. There are a few key factors to consider. First, you want to look at the potential returns, which are usually expressed as an annual percentage yield, or APY.
So higher APY means more rewards, right?
Generally speaking, yes. But you also need to consider the lockup period, which is the amount of time your crypto will be locked up in the staking contract.
So there's a trade-off. Higher rewards might come with longer lockup periods.
Exactly. Some platforms offer flexible staking, where you can unstake your crypto at any time, but the rewards are usually lower. Other platforms require you to lock up your crypto for a fixed period, often several months or even a year, but the rewards are typically higher.
So it really depends on your investment timeline and how much liquidity you need.
Absolutely. And it's not just about the numbers either. You also want to choose a platform that you trust, one that has a proven track record of security and reliability.
Okay, so do your research, compare APYs and lockup periods, and choose a platform with a good reputation. Got it. What else do we need to know about staking?
Well, it's important to understand the specific staking mechanisms of the cryptocurrency you're interested in. Some cryptocurrencies use a proof of stake, POS, consensus mechanism, where stakers are randomly selected to validate transactions and earn rewards.
So it's like a lottery where you have a better chance of winning if you have more crypto staked.
That's a simplified way of putting it, but yes. The more crypto you stake, the higher your chances of being selected to validate transactions and earn rewards.
Interesting. What about other types of staking?
Some platforms offer delegated staking, where you delegate your voting rights and staking power to a validator node. This can be a good option if you don't have enough crypto to stake on your own, or if you don't want to deal with the technical complexities of running a validator node yourself.
So you're essentially pooling your resources with other stakers.
Exactly. And there are other variations of staking, such as liquid staking, where you receive a tokenized representation of your staked crypto that you can trade or use in other DeFi protocols.
Wow, there's so much to learn about staking. It's definitely more complex than I initially thought.
It can be, but it's also a rewarding way to earn passive income with your crypto.
All right, let's move on to another strategy that piqued my curiosity. Trading. I have to admit, the fast-paced world of trading seems a bit intimidating.
It can be, especially if you're new to it,
Mm-hmm.
but it's also an exciting way to potentially grow your crypto holdings quickly.
In the last part, you mentioned a few different trading styles. Day trading, swing trading, and scalping. Can you break those down a little more for us?
Sure, day trading, as the name suggests, involves making multiple trades within a single day, aiming to profit from small price movements. It's a very active style of trading that requires constant monitoring of the markets and quick decision-making.
So you need to be glued to your computer screen all day, watching charts and analyzing data.
Pretty much. Day traders often use technical analysis to identify patterns and trends in the markets. And they use various trading strategies, such as arbitrage, scalping, and news trading, to try to make profits.
That sounds like a full-time job in itself.
It can be. And it's not for everyone. It requires a certain personality type, someone who can handle the stress and volatility of the markets and make quick decisions under pressure.
What about swing trading? You mentioned that it's a bit more relaxed approach.
Swing traders typically hold positions for days or even weeks, aiming to profit from larger price swings rather than the small intraday fluctuations that day traders focus on.
So you're not constantly glued to your screen, but you still need to keep an eye on the markets.
Absolutely. Swing traders use a combination of technical analysis and fundamental analysis to identify potential trading opportunities.
Can you explain the difference between technical analysis and fundamental analysis?
Technical analysis involves studying charts and historical price data to identify patterns and trends that might indicate future price movements.
So it's like trying to predict the future by looking at the past.
In a way, yes. It's about looking for repeating patterns and indicators that can give you an edge in the markets.
And fundamental analysis.
Fundamental analysis, on the other hand, focuses on the underlying factors that drive the value of a cryptocurrency, such as the technology, the team, the adoption rate, and the overall market sentiment.
So it's more about understanding the intrinsic value of a cryptocurrency rather than just looking at the charts.
Exactly. It's about looking at the bigger picture and trying to assess whether a cryptocurrency is undervalued or overvalued based on its fundamentals.
That makes sense. So swing traders use both technical analysis and fundamental analysis to make informed trading decisions.
Yes. They might look for cryptocurrencies that are showing strong technical signals, such as breakouts or bullish patterns, but they also want to make sure that the fundamentals of the project are solid.
And what about scalping? That sounded like the most intense type of trading.
Scalping is all about making small profits from tiny price movements, often executing multiple trades within minutes or even seconds. It's a very high-frequency style of trading that requires specialized software and a deep understanding of market dynamics.
I think I'll stick to buying and holding and maybe dabble in a little staking for now. Scalping sounds way too intense for me.
It's definitely not for everyone. It's best to start with a trading style that aligns with your personality, risk tolerance, and time commitment.
So we've got day trading for the adrenaline junkies, swing trading for those who like to ride the waves, and scalping for the super fast gunslingers. What's next on our trading adventure?
Let's talk about the different platforms you can use to trade cryptocurrency. There are a lot of options out there, but some of the most popular ones include Binance, Coinbase, Kraken, and KuCoin.
I've heard of those. They're like the stock exchanges of the crypto world, right?
That's a good analogy. They're essentially online platforms where you can buy, sell, and trade cryptocurrencies.
But how do you choose the right platform for you?
There are a few key factors to consider.
Okay, let's break those down. What about fees?
Trading fees can vary significantly from platform to platform, so it's important to compare the fee structures before you choose a platform. Some platforms charge a flat fee per trade, while others charge a percentage of the trade value.
So if you're making small trades, a flat fee might be better, but if you're making large trades, a percentage fee might be more cost-effective.
Exactly. And some platforms offer discounts for high-volume traders or for using their own native tokens.
What about security? That's always a big concern with crypto.
Absolutely. You want to choose a platform that has a strong track record of security and has implemented robust security measures, such as two-factor authentication, cold storage for funds, and regular security audits.
So don't just go with the cheapest platform. Make sure they have a good reputation for security.
Right. And then there's the issue of user experience. Some platforms are more user-friendly than others, especially for beginners. You want a platform that's easy to navigate, has clear charts and graphs, and offers good customer support.
It's like choosing a bank. You want one that's secure, reliable, and easy to use.
Exactly. And just like with banks, it's a good idea to diversify your crypto holdings across multiple platforms. Don't put all your eggs in one basket.
Good advice. So we've covered trading styles and platforms. What else do we need to know before we start clicking the buy and sell buttons?
Well, it's important to develop a trading plan and stick to it. This includes setting clear goals, defining your risk tolerance, and determining your entry and exit points for each trade.
So don't just jump in headfirst without a plan.
Definitely not. And it's also important to manage your emotions. Trading can be a roller coaster ride, and it's easy to get caught up in the hype or panic when the markets are volatile.
So stay calm and don't make rash decisions.
Exactly. And remember, there's no guarantee of profits in trading. You can win some and you can lose some. It's important to accept that risk and not invest more than you can afford to lose.
Okay, trading seems like a whole world unto itself. Maybe we should save a deeper dive into specific trading strategies for another episode.
That's probably a good idea. There's a lot to learn, and it takes time and experience to become a successful trader.
All right, let's move on to another strategy that we touched on in the last part, yield farming. I'm still a little fuzzy on how it works.
It can be a bit confusing at first, but it's essentially about lending your cryptocurrency to decentralized finance protocols in exchange for rewards.
So it's like putting your money in a high-yield savings account, but instead of a bank, you're lending to a decentralized protocol.
That's a good way to think about it. You're essentially providing liquidity to these protocols, and in return, you're earning a share of the fees generated by the platform.
Okay, that makes sense. But you mentioned something called impermanent loss, which sounded a bit scary. Can you explain what that is?
Sure. Impermanent loss is the risk that you could lose money if the value of the cryptocurrencies you've deposited into a liquidity pool changes significantly relative to each other. It's called impermanent because the loss is only realized if you withdraw your funds from the pool.
So if I just leave my crypto in the pool, I don't have to worry about impermanent loss.
That's not entirely true. The loss is still there. Even if you don't withdraw your funds, it's just that you haven't realized the loss yet.
Okay, so it's a potential loss that could become a real loss if you withdraw your funds at the wrong time.
Exactly. And it's one of the risks you need to be aware of when yield farming.
What are some other risks to consider?
Well, as with any DeFi protocol, there's always the risk of smart contract vulnerabilities. Smart contracts are the code that governs these protocols, and if there's a bug in the code, it could be exploited by hackers.
So you're essentially trusting that the code has been thoroughly audited and is secure.
Right. And you also need to be aware of the risk of rug pulls, where the developers of a protocol abandon the project and run off with the investors' funds.
That sounds like a nightmare.
It can be. That's why it's so important to do your research before investing in any yield farming protocol. Look for projects with a strong team, a transparent track record, and a well-audited code base.
Okay, so yield farming has the potential for high rewards, but it also comes with some significant risks. It's definitely not for the faint of heart.
That's true. But for those who are willing to do their research and take calculated risks, it can be a lucrative way to earn passive income with their crypto.
All right, let's switch gears again and talk about mining. In the last part, we talked about how mining involves solving complex mathematical problems to validate transactions and earn rewards. But how do you actually get started with mining?
The first step is to choose a cryptocurrency to mine. Bitcoin is the most popular cryptocurrency to mine, but there are many other options out there, such as Ethereum, Litecoin, and Monero.
So how do you choose which cryptocurrency to mine?
It depends on a few factors, including the profitability of mining that cryptocurrency, the hardware requirements, and your own personal preferences.
What do you mean by profitability?
The profitability of mining a cryptocurrency depends on factors like the price of the cryptocurrency, the difficulty of mining it, and the cost of electricity.
So if the price of a cryptocurrency goes up, it becomes more profitable to mine.
Generally, yes. But the difficulty of mining also increases as more miners join the network, which can offset the increased profitability.
So it's a bit of a balancing act.
Exactly. And then there's the cost of electricity, which can be a significant factor in mining profitability. Miners need to use a lot of electricity to power their mining rigs. So if electricity is expensive in your area, it might not be profitable to mine.
Okay, so choosing the right cryptocurrency to mine is the first step. What's next?
Next, you need to choose a mining method. There are two main methods, solo mining and pool mining.
What's the difference?
Solo mining means you're mining on your own, trying to solve the mathematical problems yourself. If you're successful, you get to keep all the rewards. But it's also very difficult to mine solo because you're competing against a vast network of other miners.
So it's like trying to win the lottery on your own.
Pretty much. Pool mining, on the other hand, involves joining a group of other miners who pool their resources together.
So it's like joining forces with other lottery players to increase your chances of winning.
Exactly. The rewards are shared among the members of the pool based on their contribution to the pool's hash rate.
Hash rate? What's that?
Hash rate is a measure of the computing power of a mining rig. The higher the hash rate, the more calculations the mining rig can perform per second, which increases the chances of finding a block and earning rewards.
Okay, so pool mining seems like a safer bet than solo mining, especially for beginners.
It usually is, but it's important to choose a reputable mining pool with a fair reward system and low fees.
Okay, so we've chosen a cryptocurrency to mine and a mining method. What else do we need?
Next, you need to get your mining hardware. As I mentioned earlier, mining requires specialized hardware, such as ASICs or GPUs.
ASICs,
Yeah.
GPUs. Can you explain what those are?
ASICs are specialized chips that are designed specifically for mining a particular cryptocurrency. They're much more efficient than GPUs at mining, but they're also more expensive and less versatile.
And GPUs?
GPUs are graphics processing units, which are originally designed for gaming, but can also be used for mining. They're less efficient than ASICs at mining, but they're also more affordable and more versatile.
So if you're just starting out with mining, a GPU might be a better option.
It could be, but it really depends on the cryptocurrency you're mining and your budget.
Okay, so we've got our cryptocurrency, our mining method, and our hardware. Are we ready to start mining?
Almost. You also need to set up your mining software and configure your mining rig. There are various mining software programs available, both free and paid. And the configuration process can be a bit technical, so it's helpful to have some technical expertise or to consult online resources for guidance.
Okay, so mining is not exactly plug and play. There's some setup and configuration involved.
That's right. But once you have everything set up, you can start mining and hopefully start earning rewards.
All right, let's move on to a topic that sounds a lot more fun. Play-to-earn games. I'm really fascinated by this concept of earning money by playing video games.
It's a growing trend that's blurring the lines between gaming, entertainment, and finance.
In the last part, we talked about Axie Infinity, Decentraland, and the Sandbox as examples of P2E games. Can you give us a little more insight into how these games work?
Sure. Axie Infinity is a blockchain-based game where players collect, breed, and battle digital creatures called Axies.
I tried out Axie Infinity myself. It was actually pretty fun.
It is a popular game. Players can earn cryptocurrency by winning battles, completing quests, and breeding Axies that can be sold to other players.
So it's like Pokemon, but with real money on the line.
That's a good way to think about it. And it's not just about the money either. Many players enjoy the community aspect of Axie Infinity and the opportunity to own and trade their own unique digital assets.
What about Decentraland?
Decentraland is a virtual world where players can own land, build structures, and create experiences that can be monetized.
So it's like a virtual real estate market.
Exactly. Players can buy and sell virtual land parcels, develop their land into businesses or attractions, and even host virtual events.
That sounds pretty amazing. And what about the Sandbox?
The Sandbox is another virtual world that focuses on user-generated content. Players can create and trade NFTs, participate in games and events, and earn rewards for their contributions.
So it's like a giant virtual playground where you can create anything you can imagine.
Pretty much. And just like in the real world, you can earn money in the Sandbox by creating and selling valuable goods and services.
These P2E games sound incredibly innovative and potentially lucrative. Are there any other examples you can share?
Sure. There's Gods Unchained, a blockchain-based trading card game where players can own and trade their cards as NFTs. There's also Illuvium, a role-playing game that combines elements of Pokemon with open-world exploration and NFT collecting.
Wow, the P2E space is exploding with creativity.
It certainly is.
Yeah.
And it's still early days. It'll be interesting to see how these games evolve in the coming years and how they integrate with other aspects of the metaverse.
All right, let's shift gears one more time and talk about affiliate programs. You mentioned earlier that affiliate programs are a classic way to earn money online. How do they work in the crypto world?
It's very similar to traditional affiliate marketing. Many crypto exchanges, wallets, and other platforms offer affiliate programs where you can earn commissions by referring new users to the platform.
So if I have a website or a social media following, I can promote these platforms and earn money if someone signs up or makes a purchase using my referral link.
Exactly. The commission rates and payment structures vary from platform to platform, so it's important to do your research and compare the different programs before you choose one.
Okay, so how do I find good affiliate programs to join?
Most crypto platforms have information about their affiliate programs on their websites. You can also search for crypto affiliate programs online to find lists of available programs.
And what are some tips for being successful with crypto affiliate marketing?
Well, the same principles that apply to traditional affiliate marketing also apply to crypto affiliate marketing. You need to build a strong online presence, create valuable content that resonates with your target audience, and promote your affiliate links in a way that's ethical and transparent.
So don't just spam your followers with links. Provide valuable information and build trust.
Exactly. And it's important to choose products or services that you genuinely believe in and that align with your values.
All right, last but not least, let's talk about creating content or educational materials related to cryptocurrency. You mentioned this as a potential way to earn money while also contributing to the growth of the crypto community.
That's right. The demand for crypto education is growing rapidly, and there are many opportunities for those who are passionate about crypto to share their knowledge and earn money.
So what are some ways to create crypto content?
You can start a blog or YouTube channel, create online courses, write ebooks or articles, or even offer one-on-one consulting services.
That sounds like a lot of work.
It can be, but it's also very rewarding, and there are many resources available to help you get started, such as online courses, communities, and mentorship programs.
Okay, so what are some tips for creating successful crypto content?
The key is to provide valuable, accurate, and engaging content that resonates with your target audience.
So know your audience and what they're looking for.
Exactly. And it's important to be consistent with your content creation. Don't just post once in a blue moon. Establish a regular posting schedule and stick to it.
And how do you actually monetize your content?
There are several ways to monetize crypto content, including placing ads on your website or YouTube channel, partnering with sponsors, offering paid subscriptions to exclusive content or communities, and selling your own products or services, such as courses, ebooks, or merchandise.
So there are quite a few options available.
Yes, and you can even combine multiple monetization methods to create a sustainable income stream.
That's great. So if you're passionate about crypto and you enjoy creating content, there's definitely potential to earn money while also sharing your knowledge with the world.
Absolutely. And who knows, maybe you'll even become the next crypto influencer.
All right, we've covered a lot of ground in this part of our deep dive. We talked about staking, trading, yield farming, mining, P2E games, affiliate programs, and content creation. I'm feeling a little overwhelmed, but in a good way.
It's a lot to take in, but it's also incredibly exciting to see all the different ways that people are using crypto to earn money and create new opportunities for themselves.
Totally. And we're not done yet. In the next part, we'll discuss some important risks and precautions to keep in mind when venturing into the world of crypto.
Stay tuned for more crypto adventures.
Welcome back to the deep dive. So far, we've journeyed through the exciting, sometimes overwhelming, world of making money with crypto.
We've explored a diverse range of strategies, from the laid-back approach of buying and holding to the heart-pounding world of high-frequency trading.
And let's not forget those mind-bending concepts like yield farming and the metaverse magic of play-to-earn games.
But before we wrap up our crypto adventure, it's crucial that we address the elephant in the room: the risks and precautions that come with navigating this decentralized frontier.
Right, because as much as we love exploring the potential upside, it wouldn't be a responsible deep dive if we didn't equip our listener with the knowledge to stay safe and make informed decisions.
Absolutely. And perhaps the most prominent risk, which we've touched upon throughout this episode, is the notorious volatility of the crypto market.
It's like the Wild West out there sometimes. Prices can swing dramatically in a matter of hours, even minutes.
That's why it's so important to approach crypto investments with a long-term perspective and a healthy dose of caution. Don't invest more than you can afford to lose, and be prepared for the inevitable ups and downs.
It's a bit like riding a roller coaster, right? You know there will be drops, but you're in it for the thrill of the ride and the breathtaking view from the top.
That's a great analogy. And speaking of breathtaking drops, another crucial aspect to consider is security. The decentralized nature of cryptocurrency, while being one of its strengths, also makes it a prime target for hackers and scammers.
Yeah, it's like that old saying, with great power comes great responsibility. Owning crypto gives you more control over your assets, but it also means you're responsible for securing them.
Exactly. Think of it this way. If you were carrying a suitcase full of cash, you wouldn't just leave it unattended in a public place, would you?
Definitely not. I'd be clutching that thing like it was my firstborn child.
Well, your crypto holdings deserve that same level of care and attention.
So what are some practical steps our listener can take to protect their precious crypto?
First and foremost, use strong, unique passwords for all your crypto accounts. And I mean really strong passwords, not just password 123.
Something like crypto is king 12345 should do the trick, right?
Not quite. Think random combinations of letters, numbers, and symbols, preferably stored in a secure password manager.
Okay, strong and unique passwords. What else?
Enable two-factor authentication, 2FA, on every single account that offers it. This adds an extra layer of security by requiring you to enter a code from your phone or email in addition to your password.
That's a good one. I use 2FA for everything now. It's a bit of a hassle sometimes, but it's worth the peace of mind knowing that my accounts are more secure.
Absolutely. And speaking of security, let's talk about wallets. Where you store your crypto is just as important as how you secure your accounts.
Right, because if you lose your wallet,
Yeah.
you lose your crypto. There's no calling up the bank to cancel your crypto credit card and get a new one.
Exactly. So let's break down the different types of wallets, because understanding the options is key to making an informed choice.
Lead the way. I'm all ears.
The first category is software wallets, which can be further divided into hot wallets and cold wallets.
Okay, hot wallets versus cold wallets. What's the difference?
Hot wallets are connected to the internet, which makes them convenient for everyday transactions, but also more vulnerable to hacking. Think of them like your everyday wallet that you carry around with you.
So they're good for small amounts of crypto that you use frequently.
Exactly. Now, cold wallets, on the other hand, are offline, which makes them much more secure for storing larger amounts of crypto that you're not actively trading. Imagine a safe deposit box at a bank.
Okay, so cold wallets are for long-term storage, like our HODL stash.
Precisely. Now, within the realm of cold wallets, there's a popular option called hardware wallets.
Hardware wallets? Those sound serious.
They're physical devices, often resembling USB drives, that store your private keys offline. This makes them extremely resistant to hacking, as long as you keep the device itself safe.
So it's like having a tiny portable vault for your crypto.
That's a good way to think about it.
Okay, so I've got hot wallets for convenience, cold wallets for security, and hardware wallets for the ultimate peace of mind. But how do you actually choose the right wallet for your needs?
It depends on several factors, including how much crypto you're storing, how often you're transacting, and your level of comfort with security.
So for someone who's just starting out with small amounts of crypto, a hot wallet might be sufficient. But as your holdings grow, you'll want to consider a cold wallet or a hardware wallet for added security.
Exactly. And it's always a good idea to diversify your storage, just like you would with any other asset. Don't keep all your crypto in one place.
Okay, that makes sense. So secure passwords, 2FA, and choosing the right wallet are all essential for protecting your crypto. What else should our listener be aware of?
Well, remember when we talked about DYOR? Doing your own research is absolutely crucial in the crypto world, especially when it comes to avoiding scams.
Right, because the crypto space is still relatively unregulated, which means there are a lot of bad actors out there trying to take advantage of unsuspecting investors.
Unfortunately, that's true. So be wary of any investment opportunity that sounds too good to be true.
If someone promises you guaranteed returns or tells you it's a once-in-a-lifetime opportunity, run in the other direction.
Exactly. And do your research before investing in any ICO, token sale, or other crypto-related venture. Look for red flags, such as anonymous developers, unrealistic promises, or a lack of transparency.
And if you're ever unsure about something, it's always best to seek advice from a trusted financial advisor or someone with experience in the crypto space.
Absolutely. It's better be safe than sorry.
Okay, we've talked about volatility, security, and avoiding scams. What about the legal and regulatory landscape of crypto? That seems to be constantly evolving.
It is a rapidly changing landscape, and it's important to stay informed about the latest developments in your jurisdiction.
Because crypto regulations vary widely from country to country, right?
That's right. Some countries have embraced crypto with open arms, while others have taken a more cautious approach or even outright banned it.
So before you invest in crypto, make sure you understand the legal and tax implications in your country.
Absolutely. And it's a good idea to consult with a tax professional if you have any questions.
Okay, so volatility, security, scams, regulations. Is there anything else our listeners should keep in mind as they embark on their crypto journey?
One last piece of advice that applies to any investment, but especially to crypto. Don't put all your eggs in one basket.
Diversification is key, right?
Exactly. Instead of investing all your money in a single cryptocurrency or project, spread your investments across a range of assets.
So if one investment goes south, you're not completely wiped out.
Right. Diversification helps to mitigate risk and can potentially increase your overall returns over the long term.
All right, I think we've covered just about everything. We've explored a wide range of strategies for making money with crypto, discussed the risks and precautions, and emphasized the importance of research, due diligence, and responsible investing.
We've certainly had a comprehensive deep dive into the exciting world of crypto.
Hopefully this has equipped our listener with the knowledge and confidence to navigate this ever-evolving landscape.
Remember, the crypto world is constantly changing, so stay curious, stay informed, and most importantly, never stop learning.
And who knows, maybe you'll discover your own golden nugget along the way.
Happy investing!